Started with $1 in a dream. This one for all the people that said I couldn't do it.
Good day,
You
Jesus.
know the best feeling in the
Thank
world?
you so much for making it on to lesson 8. And on this lesson, we'll be looking at the risk-reward ratio, the take profit, and the stop loss. And now the topics that will be covered on this lesson is the definition of the risk-reward ratio, calculating risk-reward ratio, calculating the win rate, stop loss and take profit, how and when to exit a trade, and we'll be taking a look at how to make better trading decisions. Let the lesson begin. The definition of risk-reward ratio. If you take a look, the risk represents the amount you're willing to risk. The reward represents the amount you're willing to get as a reward. So it's the ratio between the amount you're willing to get as a reward and the amount you're willing to risk. Therefore, risk-reward ratio can be seen as the amount you're willing to lose over the amount you're willing to gain. And the formula for calculating it is the risk-reward ratio is equals to the take profit distance over the stop loss distance. And now, how do we get to calculate the risk-reward ratio? Every businessman has before entering a deal an idea of how much he is ready to spend or lose to gain that specific profit. But in trading, no one has an idea of how much they lose to gain X profit. Example. Let's look at the first example. A businessman says he's ready to spend 100 rand on a shirt to sell it for 150 rands. Means he's ready to risk 100 rand to make 50 rands. Okay, now let's look at the second example. He now thinks to make the shirt for 50 rand in China and try to sell it at 150 rands, the same price. Now the risk is 50 rand, but the gain is 100 rand. Now we can see at the first example here, we've got the man he's making the shirt with 100 rand, he's selling it at 150 rand, meaning that he's risking 100, is gaining 50 rands. At the second scenario, we can see that the man is making the shirts 50 rand, he's selling at the same price, which is 150. Now he's risking 50 rand to gain 100 rands. So he would think, even if I can sell 50% of the manufacture, I will receive my capital back. Unfortunately, in trading, very few people think like that. Usually, you see 90% of people satisfied with taking 10 rand profit. But when they lose, they leave their trades running in loss of 500 on one trade. If your stop loss is 30 rands, then your profit is 30 rand or more. Okay, if your stop loss is 30 rand, then your profit should be 30 rands or more. Nevertheless, this is where you can grow in the markets. Okay, we're able to see the first example and the second example. Now, obviously, we'd say that the smartest choice is to pick the second example. Now, in trading, people don't normally use this method because whenever they open a trade and it goes blue, it gives them profit, they're quick to take that profit. But then whenever it's a loss, they'd rather say, let me hold it and wait for it to come back to zero so I can take zero as a loss. I don't want to take a loss. And then that's where it'll result to people taking 10 rand profits but leave trades running in a loss of 500 rands on one trade. So we should be careful of that. Now let's look at calculating the win rate. We've got the risk reward ratio. If your risk reward ratio of, okay, let me go back. Let me go back and explain. In this manner, we saw that the man is, in the first example, we saw that the man is spending 100 rand to gain 50 rand. Meaning that he's spending one. Okay, let me draw this here. Meaning that this man is spending 1 to gain 0.5. 0.5. This can never be seen as a good trade. Can never be seen as a good trade. And now let's look at the second example, meaning that he's risking 50 rand to gain 150. He's risking 1 to gain 100 rands. Meaning that 50 rands, he's gaining 100 rand. He's gaining 2. Meaning that, as we can see here, we said that if he can sell 50% of the manufacturer, I will receive my capital. He will receive his capital back. Meaning that if 50% of the stocks that he bought is out, people purchased it, his money would be back. And then from that 50%, it'll be profits. It'll be profits. So now with the first example, the risk reward ratio is 1:0.5. With the second example, the risk reward ratio is 1:2. 1:2. Okay, now let's move on to the next one and see how to implement the win rate. We can see here when your risk reward ratio is 1:0.5. Basically, what it states is that if you have a win rate of 67%, meaning it's out of 100 trades. We use this example, out of 100, so let's say 100 trades were taken. Your win rate is 67%, meaning that your 2 winners will result to 1 loser. If you have 2 winning trades and you get 1 losing trades, you are at break even, you are at zero, you are not in profit and you are not in loss. If you have 2 winning trades and 1 losing trades. So now it states that your strategy has to be way. Your win rate should actually be up. Let's say out of 100 trades, 67 of your trades should be the ones that they hit target to be able to stay consistent in the forex market. Okay, now let's move on to the win rate the risk reward ratio when it is 1:1. If you have a win rate of 50%, 1 winner is 1 loser, meaning that if you win out of 100 trades and 50 out of 100, if you have a risk reward ratio of 1:1, out of 100 trades, at least 50 trades should go in your direction. At least 50 trades should go in your direction. Then from there, we'll start to be able to say you are profitable. And you can see here 1 winner equals to 1 loser, meaning that if you take 2 trades and they hit stop loss, it'll hit you a specific amount. And if you take 2 trades again and they hit your target, it'll hit you a specific amount. And all those 4, you took 2 trades and they hit your stop. You took 2 trades, they hit your win. Those all, when you add them up, you result back to 0. Like you're not in the winning or in the losing. You are you are now brought back to break even. Now let's look at the risk reward ratio of 1:2. Now with the forex chaser strategy, we're dealing with the risk reward ratio of 1:2 and more. We'll look at it. Okay, we've got here 1:2, meaning that with the win rate of 33%, you are still able to stay consistent in the market. This is for you to stay consistent in the market using a win rate of 1:0.5, you need 67% win rate percentage. For you to stay consistent using the win rate of 1:1, you need 50% of consistency and 50% of profit trades, like the trades that go in your direction. And for you to stay consistent in the forex market with the win rate of 1:2, you need at least 33%. That means out of 100 trades, if 33 trades go in your 33 trades go in your direction, out of 100 trades, if 33 trades go in your direction, you are still able to stay consistent. You are able to stay consistent, meaning that 1 winning trade will result to 2 losers. If you take 4 trades and let's say 2 of them are losers and 2 are winners, you'll be in profits. You'll be in profits. If you take a trade and 2 of them lose and 2 of them win, 1 trade will bring back the 2 losses that you experience. Only 1 trade will bring back the 2 losses that you experience, and the other trade will put you in profits. This is the advantage of the risk reward ratio of 1:2 and more. Because if you take a look at the 1:3, we've got the win rate of 25%. You need the win rate of 25% to stay consistent. Meaning that out of 100 trades, if you've got a win rate of 1:3, out of 100 trades, if you've got if you got a risk reward ratio of 1:3, out of 100 trades, if it happens that only 25 trades go in your direction, 25 trades goes in your direction, and you lose what? You take you lose 75 trades. You still will be in at break. You won't be in losing. You won't be seen as a losing trade. Don't be seen as a losing trader, because your risk reward ratio is 1:3. One winner will make up 3 losses. One winning trade of yours makes up 3 losses. And the win rate here is calculated by dividing the number of wins by the number of total trades. The number of wins and the number of total trades. And the steps to take are: you should measure your trade, calculate the risk reward ratio, compare it with the win rate, your win rate, and make better trading decisions. Meaning that measure your trades. Okay, I'm taking a buy trade, and with the buy trade, I'm going to lose 30 pips. When I'm losing 30 pips, that means I have to gain 60 pips or more. So it means that if you gain 90 pips, your win rate is, you're losing 30 pips 1, and you're gaining 90 pips, your win rate is 3. It's 3. That's a wonderful trick to be involved in. Stop loss and take profit. 90% of people don't put stop loss, and those are seen as the losing traders. If your strategy is profitable while your stop loss is there, you are a good trader. High reward doesn't come from high risk. It comes from high education. You must invest in your knowledge. Others look for stop loss and take profit orders according to risk reward, amount of money, and pips. Meaning that your stop loss and your take profit are actually they're actually personal. Meaning that other people would be looking at it like using the risk reward strategy. Others would be like, no, my stop loss, I don't want it to hit me more than $30, or a specific amount. And pips, you can be like, no, I don't want my stop loss to ever exceed 50 pips. 50 pips. So it depends on how you view your stop loss and take profit. And a good entry will result to a great risk reward. Okay, now let's move on to how and when to exit a trade. You can move your stop loss in favor of your trade. Meaning that whenever a trade goes in your direction, you move your stop loss. You keep on adjusting it. When you take a buy trade and the trade goes, the more up it goes, the more further up it goes, you keep on moving your stop loss so that it comes back. It'll either hit you at break even or it'll hit you in profits. You keep on adjusting your stop loss. That's what I mean. And get stop loss to break even as quick as possible. Meaning that you don't have as quick as possible doesn't actually mean that whenever it goes into profit, you put it down to break even. What it means is that let's take a look at something like this. Okay, now let's say we take a buy trade. It came back down here. Okay, done something like this. We here now. We see something like this happening. Let's say it's here. Then we say buy. We take a buy trade. And then it gets here. It comes back down. Let's say we bought it somewhere here. Comes back down to test that same support. And then it moves up. What do you mean by saying get your stop loss to break even as quick as possible? Once it's done this, we can see that it formed it's a higher low, higher low, higher low. So now we are able to protect this area. Put your stop loss here and your target is still here. So this is a risk-free trade. Your initial stop loss was here. The market went up, came back to retest, went back up. You move the stop loss from this area to here. It's now in break even. And now you are experiencing a risk-free trade. And there's no specific area to put stop loss because it's personal. That is true. Because we saw in the previous topic, we stated that others look for stop loss according to money-wise, others according to pips, and others according to risk reward. Okay, now let us take a look at this topic where we can talk on how to make better trading decisions. Number one, you should always have a stop loss when you invest in money. You can't just put all your money in an investment. Have a stop loss. Have yourself a limit of, I don't want my money to exceed this percentage when it does go in my opposite direction. And when placing a trade, your reward should be twice as much or more with the risk-reward ratio of 1:2 and more. But nevertheless, whenever you're taking a trade, your reward should be twice as much as what you are risking, because not all trades will go in your direction. Not all trades will go in your direction. So with the risk reward ratio of 1:2, it's much better to stay profitable, because that's what we're seeking in the financial market. We're seeking profitable consistency, to remain consistently profitable. And before entering an order, calculate your entry, your stop loss distance, and your target distance. Before taking a buy or a sell trade, calculate where you're going to put your stop loss and calculate where you're going to put your take profit. And then from there, calculate your risk reward, if it's a good trade or not. And minimize your losses as possible and maximize your profits, meaning let your profits run and cut your losses short. And this will be done once you master the risk reward strategy. Once you master the risk reward strategy, this is how you'll learn on how to minimize your losses and maximize your profits. Okay, now Chases, we've got the euro dollar here. This is the 60-minute. The 60-minute, and we're able to see that it has printed a pattern that will likely to break to the downside. So now we can only seek to take advantage of sell trades. For sell trades. So now, since we're speaking on the risk reward, the risk reward ratio, for us to be able to take a good trade on this, is that we're expecting a move like this. Let me give you, okay. It has to break down up until this target here to create our lower lows. To create our lower lows, because on the bigger time frame it states that it's going down. Okay, it has to break this low. We put this as our target. Okay, so now for us to confidently say that now we're going down is for it to break this support line, this trend line here we've got here. So once it does break here, it has confirmed with us that it's going all the way down to break here. So we get down something like this. Wait for the market to impulse all the way down here. Once it does impulse down, it broke it. We can see that it broke it. Wait for it to correct. And it will likely impulse down, give us another correction before hitting our target, and then go down. So now we don't know what will happen here. It will either form a correction to the downside, because we saw with the bigger time frame it's going down, or it will be likely to come back up and test this line before going all the way down. So now, with this being said, we take advantage of these small sell setups, these corrections here. We take advantage of them, and we say that we take a risk reward ratio of 1:2 or more. 1:2 or more. Now another person would do something like this. They would sell here, put the stop loss here. That would be a good trade too, but for us, the stop loss is way too far, because the stop loss is 60 pips, and we don't want to lose such money. So now we look for areas such as this. It broke down. We saw that it confirmed our downward trend. Now it's starting to correct with the pattern that shows that we're going all the way down. Then we wait for it to break that pattern. Once it does break it, we enter here with the sell setup. And our target is all the way down here to the low. Our target is all the way down there. And our stop loss is just above this high. Above the high. So meaning that our stop loss would be likely to be somewhere, 30 pips. Okay. This is our first trade that we see. This would be our ideal setup. Meaning that you can take a look here. Here's our stop loss, 29.9. This is more likely 30 pips. Our stop loss is 30 pips. Our target is 154 pips. We're losing 30 pips to gain 154 pips. This is a very good trade. And it states here that our risk reward ratio is 1:5. Our risk reward ratio is 1:5. And this is a very, very good trade to take. A very good trade to take. So now we've got our first trade here. So we go on and look for more opportunities. So the market will impulse all the way downwards. You can see from here, the market would impulse all the way downwards, give us another correction that shows that we're going all the way down. And once it does break that correction, it breaks it and starts to go impulse all the way down. We take another sell opportunity. We take advantage of that breakout. So what happens here is that we put our sells right here. Our stop loss would be just here at the high. You can see here 24 pips. Our target would be right here. So we look at the risk reward ratio. Okay, we're losing 24 pips to gain 96 pips. That's a very good trade because the risk reward ratio is saying that we're losing 1 to gain 3.9. It's more likely 1 to gain 4. We're losing 1 to gain 4. That's a very good trade. A very, very good trade. And with this trade here, once it does present itself like this, with this trade here, we move our stop loss from here to the second entry. We'll move it from here. Our first stop loss was here. We saw another sell setup right here. We move the stop loss here as soon as we enter this trade here, and then we put the stop loss in profits right here. We put the stop loss in profits, and we're able to come up with something like a trend line, something like this. We're able to come up with a trend line like that. So this would be our ideal setup at the euro dollar. This would be our ideal setup at the euro dollar for the coming week, and we're looking to take this great trade. So I believe that you guys are able to spot, are able to use the risk reward ratio to be able to stick to the consistency, because that's what we need. That's what we're focusing on. We need to stay consistency in the forex market, because everyone can buy, make money, or sell, make money. But then it's in the long run. If you aiming to invest in the market, if you aiming to create wealth in the market, the best way is to stay consistent, minimize your loss and maximize your profits. And you can see we minimized our loss by putting small stops, 30 pip stop, and our reward is way more greater. And with the second trade, the same thing. Our stop loss are small and our profits are large. Our stop loss are small and our profits are large, and that's how we use the risk reward ratio. Thank you so much for joining us on this lesson, and we're looking forward to being with you on our next lesson. Thank you.